Hi guys, welcome to Investing with JYK, and today I will do an introduction on a series that I'm thinking about doing. It is essentially a systematic approach to stock selection and stuff. So it's going to be based on a book called Five Rules for Successful Investing by Pat Dorsey. I think that book is a fantastic introduction. It goes, it starts at some philosophical question like how to approach it, and then gives out a couple of steps and teaches you on each of those steps. And then for later half of the book, it discusses different industries, some of the major industries, and some of the conclusions might be no longer correct, but most of them still apply today. And but the thought process is quite valuable, and also you can use it as like a case studies, right? So okay, so the high level ideas is that you need to have your own investment philosophy, and it could be that you always play turnarounds in cyclicals, or it could be that you always buy things that consistently generate above market returns, um, or you always find obscure um, securities or something like that, where you have less competition and stuff. So that's one thing. And then obviously you have to understand what you buy. So the bare minimum is that you need to have read the annual reports. You need to understand what a company um, does, right? So say, for example, I currently hold Cirrus Logic. And what does it do? Well, how does it make money? Very simply, it designs chips, gets them manufactured, and sell them to phone manufacturers. That's how they make money. Right? So that's quite a simple business. Or if you say, how does um, Coca-Cola make money? Well, they sell drinks, and they sell drinks for more than they cost them to make, and then they make money that way. Or how does a restaurant make money? It's very similar. They sell food at higher price than what it costs them. So you need to be able to preferably express that in one sentence. Um, so for conglomerates, which are kind of in everything, then it's kind of hard. Uh, for example, Berkshire, and how does Berkshire make money? You're like, okay, so it's a bit hard to conclude, so you have to kind of spend a bit more time to understand what business they hold. But if I were to try, I'd say buy a bunch of cash flow positive uh, businesses and collect the cash and buy another one. I guess that's Berkshire. Okay, so then once you understood the business in terms of what it does, now you have to understand, does it have a moat? Does it have multiple moats? And how long will these moats uh, last? And how much money can they extract because of this moat? So moat is this concept that's basically introduced by Buffett, and then the idea is that you can get above average returns. So average return would be typically like say 10% or 7% or whatever. So that means if you invested, uh, $100 in terms of equity, you can get out $7 or $10 a year. So if you were to get more than that, well, if you get less than that, obviously nobody's going to come because nobody cares about this, because nobody wants shitty returns. But you have more than that, so you get 15 or 20% a year on your invested equity. I'm using essentially ROE here. It's not a perfect measure, but assuming it is, if you get 15-20%, then you're going to attract competition. Because if you tell somebody, oh, I'm going to offer, here's a business that will give you 15% or 20% annually, they will be tempted. And then you attract competition. Once you attract competition, you need to be able to fend them off. So how can you keep fending them off is a question you have to answer. I'll just give some examples here. Say Coca-Cola. How does it fend them off? Well, they can charge more money all the time, because if you go to a supermarket and there's a thing that says XY Cola, and there's a thing that says Coca-Cola, and XY Cola is $1, Coca-Cola is $1.15. Well, most likely you will get Coca-Cola because I trust the brand. I know what I'm getting. I don't really want to take the chance on XY Cola. And also, Coca-Cola's advertising thing, they keep trying to associate themselves with happiness. So there's that. And then the other type is, for example, Facebook. So what does Facebook have? Facebook controls communication. So it's a network effect, and it's very difficult to remove you from that network. So network effect is one, and you got branding power, and you got a bunch of others like switching costs and stuff like that. So understand modes, and then the wider the mode, so the more difficult it is for people to replicate what you have, the longer lasting that particular thing, that mode is. And I mean, all modes eventually will go away. So if you don't keep reinvesting into it, so basically somehow you have to keep reinvesting in your modes in order to obtain that higher than average returns. And then what you need to do is have a margin of safety, because we will make mistakes. And if you demand a margin of safety and essentially take an underestimate, then if you don't make a mistake, you have outside return. If you make a mistake on the wrong side, if you actually overestimated initially, then you don't lose much, because that's already taken into account. And by the way, here the margin of safety is the difference between fair value and what you should be paying. Right? So you always try to have this margin of safety in case you make mistakes. So that concept was introduced in Intelligent Investor. It's a fairly useful book. The two central concepts are margin of safety and Mr. Market. We'll get into these later. And obviously, if you demanded a margin of safety and it turns out that your initial estimate was of fair value, of intrinsic value, was an underestimate, and then you still demanded further margin of safety, that means essentially you get outsized returns. So yeah, it's a surprise, but it's a positive surprise, and nobody hates that. And then just don't trade too often, because trading costs, and then you got taxes. It makes quite a bit of a big difference. And the last thing is, when to sell. So one way is when fair value is reflected. The other one is when you realize it was a mistake. So I'll give two recent examples on myself. So one company that I sold was Texas Roadhouse. I loved it. I think it has a clear moat, but it was no longer cheap. It no longer has a margin of safety. I sold it at around $50. Currently, it went all the way up to like 60, and then there was a recent crash. So yeah, I avoided the crash, but it kind of just fell back to $50 where I left it off. But that's the point. Like sometimes things will happen. You get these. If you no longer have a margin of safety, then the business has a hiccup, and then you get screwed. And now, in terms of mistake, for example, I bought Big Five sporting goods. It was at like $5 ish. It went all the way up to $9, and I did not sell. It went back down to about $6.50 something when it released earnings, and the earning was really bad. So I was expecting that Q2 earning would be, mostly in line with last year's. Basically, I was expecting that business to be stabilizing, but it did not. So I saw that, and I just sold out. I eventually sold out at 6. So I didn't make much money. It was I got some dividend payment, and it made like 50 cents per share. But I still sold it because I think I bought the wrong company. It actually is dying. The business is deteriorating consistently. The management came up with some I don't know if bullshit is, but some excuse to say, oh, because the July 4th was moved or something like that. So that. So that's when you should be selling. Either when the fair value is reflected, you get to the intrinsic value, then you just sell. I don't really want to play the game where say somebody, like playing the greater fool, that somebody is going to pay more for this because of whatever. It's much harder to play that game. So for me, it's better to sell at fair value, and the other one is correct your mistakes. Even if you lose money, correct your mistakes. And whenever the fundamentals does not match what you thought it would be very careful. Reassess all your assumptions and see if anything don't hold up. If they don't hold up, sell. Okay, then this will be last slide for today, and it's common mistakes. So one is long shots only. So typically you just buy all the biotech. Kind of the biotech, all the biotechs with no revenue or anything, and don't know much. You kind of just bet on all of them. It's very hard to sit through these. This might induce you to make other mistakes. The other one is marginal junior mining. Marginal junior mining typically burns capital. Yes, when they turn, it's spectacular, but it's like a consistent burn. They behave very much like options. Same as biotech, really, if you think about it. Options has expiry date. Revenues, biotech that has zero revenue is constantly burning cash, so when their runway goes out, they're at zero. They disappear. Junior mining, the marginal ones, they don't make any money, but they have corporate cost to maintain. You have to pay the CEO, and that drains the company as time goes on, and you literally just have to rely on the the commodity going up. So it's yeah. The next line, I don't know why I did not finish it. I will finish typing it, but essentially, people say things are different this time. So a couple of things. 2011, 2014 peak oil. People say, "Oh, this is it, no more oil," and then you get the shale thing. And last year, Janet Yellen came out. Was it last year or the year before? Anyway, Yellen came out saying, "Oh, we have managed the cycles. We will no longer see a recession in our lifetime, or maybe in her lifetime, because she's like 70, 80 years old." So yeah, I don't think that is gonna be a very, that line's not gonna age well. Blockchain will change everything. That's what they say. So valuation, so pay anything, and yeah, I don't know where it's going, but it has cooled down quite a bit. The other thing is, don't confuse the love for the stock to the love of the product. You can love the product and the company may not be a good investment, and I'm talking about Tesla. I think it is understandable that a lot of people love Tesla product, and it is very it is possible to monetize on that love. For example, people love Apple products. Apple charge you more. Apple has a higher margin and everything. Tesla, not so much. At least not yet. I'm not entirely convinced that, even though I'm currently short Tesla, I'm not entirely convinced that Tesla is going to go all the way downhill from here. I think there's a higher probability that they will go to zero than they will, go 10x from here, or even 2x. But that's me. But again, split those. So there's, even Peter Lynch talked about it. So he talked about some stock picker that test drove back then. It was Ford, and he loved the car, and then he said, "Oh, I'm going to invest in Ford." Not so much. It didn't do very well. So separate those. Excuse me. The next problem is panic when price declines. So to give an example, today, exactly today, August 2nd in China, 2018, all these good companies dropped like crazy. Like, for example, Gree dropped by 5%, and you have like Gree's air conditioner manufacturer, and then there's other things like the Huayu汽车, which is automotive OEM part OEM. So that dropped like 3-4%, but they are all extremely healthy companies with plenty of cash flow, very low valuation. One has like 11 or 12, the other one has a 9. So they will drop, and then you will question yourself, but then think about exactly how, like, the company's capacity of making cash, is that materially damaged because of what? Like, really nothing happened today. So yeah, be careful of those, and also be ready that these things go down 20, 30, 50%. So Gree went as high as 55 yuan just this January. Now it's sitting at 40. That's a pretty good drawdown. And the other one that I'm long is like LGIH. It went up to like $80. Now it's sitting at 50. But the company keeps growing. The company kept growing. They built more houses. They sold more of them, and the margins kept the same. They kept the margins even though the cost was going up. So they were able to pass on that cost. So yeah, always think about the fundamentals. Don't get too drawn by the price declines. And the other one's market timing. So Pat Dorsey argues that you should never time the market, blah 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 blah. But to me, one thing it's you can change. I think you can adjust your exposure to different markets or different um, stocks based on valuation. Say, US is very expensive, it might keep outperforming, but I would argue that at the moment, Russia, Eastern Europe, or China, Hong Kong, all these countries seems to be more attractive based on valuation. Yeah, US might, do well. Currently it's growing at 4%. Maybe it will keep growing at 4% for a while, but it will have to come down at some point. And the next one is ignoring valuation. So people go insane with a lot of things. I think the prime example now is, well, Tesla, Amazon, Netflix. Those are, I would think, and the other ones that are equally as bad, even though it doesn't look as egregious, are McDonald's. Is it a good company? Yeah. Does it have a strong moat? Yeah. Can it grow? Probably not. Is it a good investment? Well, at 12 PE, it's a good investment. You get a steady return. It throws off cash all the time. But currently it was like 25. So would you like to pay 25 PE for a stagnant company? Probably not. So things like that. And then you have other stuff like 3M. Is it a good company? Fantastic company. Well managed, good cash flow, very steady, 20-something XP. Yeah. So that is the problem with valuation. They all recently had a bit of a drawdown, probably because interest rate went up, but that's a separate thing. That's more macro. So we'll focus more on the micro parts. And the other thing is looking only at earnings. So two problems. One is you can end up with frauds. Enron, potentially Oriental Paper, which is a pretty old Chinese company that's still trading. I don't know why it's still here. It has never paid a dividend, and it shows that it made money, but who knows if the auditors are just playing nice with them. I don't know. And there are some like that. So don't only look at earnings, look at cash flow for companies that are outside the US. Think about dividends, because dividends cannot be faked. You will get the money. So I talked about dividends. I talked about like dividends as a signal of decent earning quality. So that's something that you might want to consider. And also there's a bunch of ratios. So 10 PE is not the same for any company. LGIH's 10 PE is probably going to be, if they don't grow much, that company's 10 PE is probably going to be shittier than, say, Coke's 10 PE, because for them, the inventory always carry a huge cost. You have to buy land, and there's interest in that and everything. But for Coke, you're just selling water and syrup. right? So it costs basically nothing, and most of what it earns will be free cash flow. So that is the best kind of earnings. And on top of that, if you have two companies that have the same PE, but one has more debt, and they are in the same business, then maybe you don't exactly want the one with more debt, because that is more risky. It is always more likely to go bankrupt. So not all earnings are equal. Keep that in mind, so you get a holistic picture of a company always before you make a decision to buy. Alright, so that is all from me today, and we shall continue this series in the future, and I will go into each of these topics in more detail. If you like this, please click like and leave me a message. I will leave some the links to the books that I mentioned down there. It's Amazon link, and it's an affiliated link. So if you want to buy it, you might as well just buy it through that link to support me. And no, it won't be any more expensive for you. Thank you very much in advance. See you next time.